Hi, Phil Weiss of Reprise Wealth Management here with a video summary of this week's blog. Social Security, could there be a tax torpedo in your future? The focus of Reprise's content this month is on Social Security. 2 weeks ago, we blogged about Social Security benefits and claiming strategies. This blog takes a look at something called the Social Security tax torpedo. If you're not sure what that is, just give me a second and I'll talk a little bit more about what it is. And last, on the 29th, that's a Thursday at 5 o'clock, we'll be hosting this month's Ask Me Anything webinar. The focus of that will also be on Social Security. So what's a tax torpedo? What do I mean? Well, your Social Security benefits are not fully taxable. Depending upon your provisional income, your Social Security benefits may not be subject to any tax at all at the low end, and at the high end, 85% of them could be taxable. Your provisional income consists of your taxable income, such as wages and interest and dividends, even your tax-free interest on things like municipal bonds, and half your Social Security benefit. You add those up, and you run a calculation and it tells you how much your Social Security might be taxable. Fully taxable Social Security, really only 85%. But there's a big window between 0 and 85%. And sometimes if you make a decision to take more income in a year, you're going to end up increasing the amount of Social Security that you have to pay tax on, so that the cost of taking that income in could be higher than what your effective tax rate might be. This sounds a little bit confusing. Read the blog. I think it'll help you understand better what can happen. This is also a reason why I recommend having diversification in the types of accounts that you have from a tax perspective. Because if you need that extra money, rather than taking more money from something like your IRA or your 401k, you can also do things like take it from a Roth if you have a Roth account, take it from a health savings account if you have one of those, or even taking it from a taxable account where all you might pay is some capital gains taxes and you're going to have some basis. So the amount of income you're going to recognize will be less. And again, depending upon your income, your tax rate on those capital gains, besides the increase in Social Security, might also be low. But I hope this isn't all clear as mud. If after reading the blog you have more questions, sign up for our webinar. Be happy to address them then, or you can send me an email. Thanks for listening. Hope you find this blog valuable, and I'll be back again next week with my 5 favorite reads blog. Have a great day.